Lots to talk about on this video on Canada's economy, inflation, interest rates, the housing market, and the forecast for 2024. So let's dive right into it. Some great news in regards to Canada's economy and inflation rate. The inflation rate for Canada came in at 3.1%, which is slightly under market expectation of 3.2. We have to keep in mind in September, we were at 3.8. So we're definitely cooling inflation and trending in the right direction. A lot of that decline in inflation was fueled by lower gasoline prices. And you can bet that the next time the Bank of Canada meets, which is our last announcement for Bank Prime, December 6th, we will probably see that interest rates have peaked at that point and they will pause again on Bank Prime. And if you consider more than 30% of our current inflationary rate right now is driven by mortgage interest, shelter costs, and also rent. And not even considering that the Bank of Canada has any role in creating inflation, we would actually be closer to 2%. So this is just a reminder that the number the Bank of Canada wants to meet is that target rate of 2%. We are actually very close to that. And with core inflation edging down to its lowest level in the last 2 years, many experts and economists are indicating that they've likely closed the door on further rate hikes. In fact, this week, the Governor of Finance, Tiff Macklem, says we actually have peaked at any further rate hikes on Bank Prime. So good news on two fronts. Inflation is trending down to the target rate of 2%, and also no more rate hikes on Bank Prime. But we have to remember that without any shelter costs, inflation today would actually be at 1.9%. So that makes shelter the number one resource for why inflation is so high right now. Mortgage interest costs attribute to 30.5% from over a year ago, and rent has rose 8.2% from 7.3% in September. Now, these costs aren't likely to drop anytime soon. What will happen is that because we have so many mortgage renewals coming up in the next 3 years in Canada, in fact, 60% of mortgages are up for renewal in the next 3 years, the base year effect of mortgage interest costs will start to decline drastically because people will be renewing in higher interest rates than where they were 5 years ago. So the big chunk of inflation right now is associated to mortgage rates being so high. 91% of households actually are feeling the stress of higher rates right now, and their income is going to shelter, food, transportation, and utilities. We have to remember back in March of 2022, this is when the Bank of Canada aggressively started to increase interest rates. This was their hike campaign and the bid to drive inflation down to the target rate of 2%. Before this campaign, the bank's key overnight lending rate was 0.25%. Now it's 5%. This is the highest level that we've seen in 2020, in actually 22 years. And this is why we're all feeling it at our pocketbooks, and savings in Canada for families and individuals is at the lowest level. The painful irony of this is that the impact of interest rates designed to reduce inflation because of the impact of shelter absolutely makes inflation worse, not better. It's hurting renters, and these higher rates are actually affecting people to be able to qualify into buying a home, or even first-time home buyers entering into the housing market. Landlords often are passing on the expenses of higher interest rates because of their mortgage onto their tenants and increasing rent. So we're seeing this exponentially. Even though gasoline prices have dropped 7.8% from year over year, gasoline prices have dropped, but grocery inflation rates have slowed down to 5.4% from 5.8% in September. So we're starting to see a bit of a slowdown on gasoline and food prices as well. You know, actually, when we look at it, a lot of these highlighted indicators that I discussed about inflation on gasoline prices, on food prices, as we start to see this starting to trend down, the biggest number one factor is interest rates. And this is when we're looking at the forecast into 2024 is very promising. With the Governor of Finance indicating no other further rate hikes for bank prime, we're also starting to see in the last 3 weeks that bond yields have started to drop down. We're seeing that the US economy is going into a recession. This is affecting bond yields, and bond yields affect our fixed rates. So we've seen about a 50 basis point reduction in fixed rates. And this leads me to my next topic, which is renewals. Canada is currently facing a major challenge in the mortgage market due to the rapid increase of interest rates over the last 19 months. And when we look at it between 2024 to 2026, in those 3 years, 90 billion worth of Canadian mortgages are coming up for renewal. That actually comprises of nearly 60% of the Canadian housing market. These renewals could result in mortgage payments increasing by an average of 32% in next year of 2024, and if rates do not change, could be 48% by the time we reach 2026. Now, the good news is the forecast is for a decrease in bank prime and also decreases in fixed rates. In fact, when we're looking at specifically bank prime, there are indicators that we could see a full percent to even 2% decrease in bank prime in the next 12 months. There is a lot of pressure on the Bank of Canada right now to start decreasing rates because of the effect that homeowners, existing homeowners that are up for renewal, are going to feel this payment shock. We could potentially see a 76% jump in interest rates in the next 3 years for people on their mortgage payments if rates don't decline drastically. So the Bank of Canada has a lot of pressure on them to increase quite quickly, and the forecast is looking at even starting in Q2 of 2024. The situation is still challenging, but there is hope on the horizon. And the forecast indicating that fixed rates and bank prime are expected to decrease in the next coming years is very positive. And for a lot of home buyers right now sitting on the sidelines, you definitely need to start relooking at your financing and have the strategy to be able to enter into the housing market again. The supply still is limited in Canada. The population growth has more than doubled since 2019. So the pent-up demand is there to be able to purchase homes. When rates start coming down, we're going to start to see values aggressively start to increase again. And it's not to say that that 2021 momentum of values increasing exponentially and the demand on the housing market is now more of a reality than ever. Now, I want to dive into some other factors. The 2023 Fall Economic Statement from the federal government on the Canadian Mortgage Charter was a comprehensive plan to help protect Canadian homeowners grappling with the challenges of soaring interest rates over the next 3 years. There are actually 6 points that I want to speak to people about because they could be looking at this program that the federal government has announced and be very confused on it. In fact, a lot of us in this industry, and I spoke to many of the banks as well, this is a very gray area that the federal government announced as measurements to help protect and ease people's payment shocks when they're coming up for renewal. So some of the 6 points that I'm going to highlight is they talked about, one, extended amortization periods. What they indicated was that homeowners facing financial stress due to rising mortgage costs will have the option to temporarily extend their mortgage amortization periods. This means by spreading out the repayment timeline, resulting in reduced monthly payments, providing much needed relief. There's still gray in this actual statement, what the banks will actually do with this, because what we do know is when a client is up for renewal with the banks right now, if their mortgage amortization is extended over and above when they originally got the mortgage, they would have to go back to that term. So let's say if the client was approved at 25 years and their amortization now is actually at 40 years because they didn't increase their payments if they were in a variable rate mortgage, it is expected for the client to go back to 25 years. So this statement is very gray, and we'll have to continue to see how this plays out with the banks. Now, number 2 is waived fees and costs. Financial institutions will be required to waive any fees or costs associated with the implementation of relief measures. We still really don't know how this will play out and what actually fees will be waived. Number 3 is no qualification. This one is where insured mortgage holders that had a mortgage coming up for renewal and were insured at the time when they got their mortgage, they will not have to meet the minimum stress test qualification rate. So they can qualify where interest rates are today. This is for insured mortgages. Early outreach. Financial institutions will be proactively reaching out to homeowners at least 4 to 6 months ahead of mortgage renewals. Now, I know as a mortgage broker, our company reaches out to our clients over 12 months prior to make sure that clients have a strong foundation. So it is good that the banks are reaching out, but you definitely want to be proactive if your mortgage is coming up for renewal, to take a look at where interest rates are today, to be prepared that even though we're in a declining interest rate environment, you still want to be able to budget where you're going to see interest rates go. Now, number 5 is lump sum payments. Homeowners at risk of financial hardship will have the ability to make lump sum payments without facing prepayment privileges or penalties. So I'm confused by this statement, because to make a lump sum payment would mean that you have to have savings and money. And if you're facing financial hardship, I find it hard to believe that you'd be able to make a lump sum payment. So I'm very confused by the statement that the government has indicated in this form. And number 6 is no interest on interest. In case the mortgage relief measures lead to temporary negative amortizations, financial institutions will refrain from charging interest on interest. Well, that's still a gray area. Speaking to many of the banks, they don't even understand where this and how this is going to affect them, and be able to communicate this to clients. So you can see a lot of these statements there, they haven't actually really thought out of what the plan is. And so when I looked at mortgage renewals coming up over the next 3 years, I realized that the impact of payment shock could be quite severe for a lot of clients. Now, the good news is interest rates are coming down. But the great news is, as a mortgage broker and with our company, we have mortgage assistant programs where are catered to help you and navigate through these times. We have extended amortization products. We have ways to be able to look at if you have overextended credit, that we can look at consolidating that credit, or debt settlement programs. And we could look at ways to help you with payment shock to alleviate times. Even though rates are coming down, they're still going to be higher than where they were 5 years ago. So make sure you reach out. The most important thing in the message right now is, if you are coming up for renewal, not even just in the 12 months, in the next 3 months, you need to make sure you have a payment plan. You have a strategy so that you're prepared for what the future may lie on interest rates. And so that when rates come down, you'll even be more ahead because you've budgeted appropriately for this. So overall, a lot of information, but a lot of great news. The great news is we're going to see interest rates come down by even 1% to 2% with bank prime. Fixed rates are coming down. We should see them come down a full 1% to maybe even 1.5% in 2024. And inflation should be sitting around 2.5% by middle of 2024. So all great news. We've reached the top of the hill and we're trending downwards right now. I hope this information provided a lot of calmness and clarity and education. Make sure you reach out. A path of financial success is about clarity, information, and education. We're here to help you navigate through these times, and happy to speak to any of you to make sure you understand how this can affect you going forward. But it looks like we're on the path of financial wellness and interest rates coming down and stabilizing in 2024.